Okay. For those of you guys that are online, if you can see my screen and hear me okay, please chat that in, let me know. If you guys are chatting on the mastermind site, I do not have the chat up for the mastermind site, so I won't see those chats. So probably want to keep that in mind. Awesome. Awesome. Thank you. Appreciate it. Okay, good. Just another minute, guys. We'll go to get started. If you guys have any questions online or in person, feel free to ask them before we get started or during, of course. All right, let's get kicking. It's kind of a thin herd tonight, even online. Wow. We were just talking about it. The weather gets warm and people are just out and about, right? It's kind of where I want to be. All right, guys. So tonight we're going to talk about the Hydra. Obviously, if you guys have any questions, even if it doesn't pertain to Hydra, just trading in general, whatever it may be, feel free to ask, and we'll get those questions answered. Oh, thanks, Brad. Appreciate it. Thanks, Kern. So I've got a whole bunch of these lined out. I went back to 12/31/2014, generally for the proving ground. By our definition, the proving ground is the time from January 2015 to current. So when we do our back testing, we back test from that point forward, and every quarter we update our back testing. And the pattern has to prove out to be 90% or greater accurate in order for us to count it as a proving ground pattern. Now, we do alert for other patterns that are common and people are aware of that are not proving ground, meaning they don't have a 90% accuracy. And in our Slack channel, we have those designated under the advanced channel. Within the advanced channel, we recommend those alerts be utilized with other disciplines in the market. For example, taking a three-pointer with the trend as opposed to just taking it based on the pattern. So the Hydra is actually one that proves out really well. It's got a 90% accuracy with just the pattern and pressure, and then you add an additional 2% when you have a contrary candle. Contrary candle just means if we're buying, we want to see the current candle at the post with the pattern be a red candle, right? A short candle. If we're selling, we want to see a long or a buy or a green candle, right? So in this particular case, we have. We'll look at that in just a second, Dan. I want to say it might still be active. Dan was just commenting on the Euro USD Hydra that posted today and was saying that it hadn't filled yet. I think the spread increased at the I can't remember when that went through, but the spread was a little larger than normal, and so we didn't get the desired result right away. But I'll look at that here in just a second. Let's let that load. Come on. Okay. So let's explain what a Hydra is and kind of look at some examples of the Hydra. So the reason why we call it a Hydra, first of all, is because it kind of has two heads. You can see it starts off with major, minor, both being in a hiccup. And I'll kind of explain what a hiccup is for those of you guys that don't know. So here, you'll notice that in just about every scenario, if the green line on the major is pointed up, then the red line on the major is pointed up. If they're pointed down, they're both pointed down. Same thing with the gray and black. Now, there's a difference between a hiccup, not aesthetically, in other words, not the way they look, but there's a difference in the way they react between the majors hiccuping and the minors hiccuping. So it's not uncommon for the minors to hiccup. So in this case, And I'll show you this one because this one's a little clearer. But in this case, you have the miners. I'll back up so you can see this. Yeah, what's with the delay? There we go. So there's a hiccup on just the miners. So it's not uncommon for the miners to create a hiccup. And a hiccup is the lines disagree, right? You can see the black is up, gray is down. They're not crossed or touching. So we want both minors and majors to create a hiccup. This is not a hiccup pattern. It's just a hiccup. A hiccup pattern is when this happens to the majors, and then there's other variables within the hiccup pattern. The hiccup pattern is made up of a hiccup, and here this is what we call a hiccup, is when the lines within the pairs don't agree. Now, it's not uncommon for minors to make this hiccup and then still, cross down. Where the majors, when they hiccup, it almost seems unnatural for them to do that. Rather, they continue and extend up. Like a duckbill, right? And a lot of times that'll be the end result is a duckbill on a 60-minute, which doesn't have the same results as a duckbill on a 1 day, but not at the high percentage that we get with the Hydra. So all we want to happen in a Hydra is for the major and minor to simultaneously hiccup. Doesn't matter where it happens within the overbought, oversold channel, something in between, doesn't matter where it happens, as long as they do it simultaneously. So I'll show you the example here. And the second variable is pressure. We want what we call short-term bias in the direction that we're looking to trade. So I'll show you how to identify which direction to trade a hiccup, and that'll tell you what you want your pressure to look like when it's present. This thing's downloading. Why is it taking so long? Goodness. Let me see if I can go forward here. Yeah, I still can. Okay. So here's a hiccup. It's kind of a poor example by way of the minors, but it's still present, right? Gray is down, black is up. Simultaneously, green is down, red is up. Now, if you can imagine these being the heads, right? Let me put an eyeball right there and right there just for visual aid. Then that means that the rest is the neck, right? I mean, I didn't go to college. I don't know about anatomy and stuff, but that's generally the way it works, right? If this is the head, this is the neck. So if this is the neck and this is the head, are these heads up, right side up, or upside down? Right side up. So when they're right side up, you buy. When they're upside down, you sell. Now, the other variable has to be present, obviously. So you've got a hiccup on major and minor simultaneously. And as this is happening, obviously, you're waiting, you're counting down the seconds before this candle ends. If this exists at the last second when this candle ends, on the very next candle is where you'd enter. You would generally not expect to see the hiccup still present when the new candle comes out, right? The indicators change instantly as soon as the new candle comes out. All you want is for the post to have all the variables present. So we've got minors in a hiccup formation, majors in a hiccup formation, heads up, and we have short-term bias to the buy side on pressure. Because we're looking to buy, because the heads are up, we're looking to buy. So short-term bias in pressure just references where the green is as it compares to the red. If it's on top of the red, that gives us short-term bias to the long side, to the buy side, up. If green is below red at the post, then that gives us short-term bias to the short side or the sell side or down. As part of the parameters for the Hydra, we want the pattern to be present and short-term bias in our favor as part of the parameters. There is another parameter that you can have that'll give you an additional 2% likelihood of success, and that's a contrary candle. So we kind of explained that a moment ago. If we're buying, I feel like I'm on the farm all of a sudden. If we're buying, we want to see a red candle, right? Or a short candle, or down, a candle that has moved down at the post. If we're selling, we want to see a green candle or a buy candle or something that moved up. and posted that way, right? So this is actually 92% likely to give us a 5 pip trade to the buy side because we've got all three parameters, major, minor, hiccup simultaneously, pressure has short-term bias in our favor, and we have a contrary candle. So next candle, we have a 90+% likely, actually 92% to be exact, likelihood of getting a 5 pip trade. And that moved 11.6. Darren, let's see. Can you wait to position using a 5-minute chart after the post before taking the trade? Absolutely. I mean, you can do whatever suits you best. I think most of you guys that are taking more than the recommended pip and sitting out on some of the alerts are doing just that. They're positioning a little more aggressively. They're passing up on some alerts trades. Even though some of the trades that they pass up work out, you've got to always consider the statistic, right? So if we're trading at a 5-to-1 on these, which is a recommendation, I wouldn't recommend. Let me clarify. That's what we can justify as a 5-to-1. I would never recommend a 5-to-1, to be honest, because that's what we can justify, and it is a systematic trade, and the math works out. Then you could take the trade with a 5-to-1, meaning 5 pip take profit, 25 pip stop loss. I wouldn't necessarily recommend that, but for someone who's brand new, especially to the pattern type trading that we do within the mastermind, it doesn't require that they have any other disciplines in the bag. They can take the pattern and it proves out to work out within those parameters. 90+% of the time, you're going to be able to get 5 pips before it draws down on you 25 pips. So that's why we've got it set up that way. And the math works out because it works 90+% of the time. So 9 out of 10 times you win that trade, that's 45 pips. And 1 out of 10 times you lose that trade, and that's 25 pips for a 20 pip profit if you took it 10 times, right? Statistically speaking. Obviously, it is possible because you're not taking every single one of them that you may hit concurrent losers, right? But over time, it should prove out to be profitable, which is why we shoot for a high likelihood of success. And we have that standard in the mastermind because it gives you every possible opportunity to be successful in that pattern trade. But utilizing other disciplines is always going to be to your formidable advantage, right? Positioning, looking at support and resistance to justify taking more profit, perhaps, or using technicals to identify a better stop or even a hedge position versus, a 5-to-1. Sometimes it's hard to tell if they're crossed or not. Even when I spread out the chart, they kind of look like they're touching, but not sure. Is there any more scientific way to determine if they've remained uncrossed? It is tough sometimes. If it's questionable, skip it. It's if it works out, it works out. But you shouldn't feel like you've missed out on anything. If you're not comfortable with it, that's where the personal evaluation comes in, right? We need to allow for you guys to take a personal evaluation of what we're presenting to you. Otherwise, it's just us taking the trade for you and you pushing the button. So we give it to you within 15 minutes to the top of the hour. And then it's up to you to evaluate that as it comes towards the end of the candle and determine if it's valid at the end at the post, right? And then decide whether or not you want to execute. Which is why it's imperative for those of you guys that are taking alerts trades to have your time settings set correctly. Otherwise, if you have them as a default, then you'll be 50 seconds behind the rest of us. So our mastermind candles end 10 seconds after the top of the hour, and the default is 1 minute after the top of the hour for a difference of 50 seconds. That 50 seconds can make all the difference sometimes. Sometimes in your favor and other times not so much. But if you're going to just use and not utilize any other disciplines to support, they have that 10-second delay versus the 1 minute delay. If you're not sure how to set that up, let me know, and I'll kind of walk you through it. Okay, so we can see that one worked out successfully just fine, right? So when we back tested these, we basically what we do is we have a series of parameters. I might have a template here. Let me see if I can find it here. So let's see. I've got, it's look at this. So here's one. This one hasn't been updated for quite some time, but you can see all of the parameters that we looked at. The pips that it went, the drawdown, the time that it took to fill, whether pressure was favorable or not favorable, meaning short-term bias, the candle if it was opposite or the same, and then we mix them up, right? Pattern, pressure, yes, candle opposite. Pattern, pressure, yes, candle the same. Pattern, pressure, no, candle opposite. Pattern, pressure, no, candle the same. And then just pressure, just pressure, yes, just pressure, no, just candle opposite or candle the same. And then we dissect the information. We do it, but this is the long way. This is the way we used to do it. We don't do it this way anymore. Now it's a push of a button. I got tech ninjas now. This used to take forever. It used to take an average of 70 hours per pattern to back test. And mind you, every 3 months that goes by adds to that time because it's 2015 to current. So after 3 months, current becomes 3 months longer than the pattern that we tested 3 months ago.
So did you have someone check for data entry errors?
I did a lot of this myself.
Over time, you're going to see things that you entered it incorrectly versus what might have been put in.
Oh, you're talking about double checking this. Oh, yeah. Yeah, we had some double check methods. Yeah, most definitely. When we, pull at random, right? So we kind of randomize and then take, 30% of it and say, okay, did these check out? And then after we updated, we would try to randomize and then pick other areas, make sure that those checked out. So it wasn't 100%, but statistically speaking, you're going to get, it's going to be accurate. But it is something that you have to be really cautious about with that respect, because with the hiccup pattern, we hit, at the time, we hit 86% with some of the parameters, right? 75%, 76%. This one was a winner at 90%, 74%, 87%. That one was really close and much simpler because it just involved, what was it? It was candle opposite. So it was just the pattern and the opposite candle, 87%, which if we gave it time could have proved out to be 90%. So we did have one that was 92%, but the frequency was decreased by a third. And so the winner was 90% and the frequency was almost whole. So that's the one. So every time we saw the pattern, we had these other parameters present, which meant that we'd get the frequency we were looking for. It's a little elusive sometimes, the Hydra, because a lot of times what will happen is it'll form, and before it posts, it'll make the move. Have you guys noticed that? You'll get the Hydra, and before the hour's up, it'll already make the move long. Miners, a lot of times when they make a hiccup, they can still cross in the down direction in this particular instance, for example. But majors, it's really uncommon for them to do that. And you realize these things by back testing, right? You realize what happens naturally and unnaturally for the indicators. And when you start putting together all of your knowledge and understanding of the market, the way it works, zero net market, how the majors play the minors, you start to really understand the dynamic of the indicators. And you start to understand some of these nuances to the point where you can utilize them within other facets, not just pattern-based. So there's a lot of nuance here that I want to kind of drop breadcrumbs for you guys so that you can glean from it and utilize it on a grander scale, right? I only got to the point where I am by countless hours. Actually, Troy is one of our coaches, and we were just having this conversation. What was it, yesterday or the day before? How he got to the level where he was by back testing. So, Troy's been with us for some time, and he's been able to grow an account successfully. Now he's a coach. But any of the coaches that you talk to that have had a level of success are going to tell you that a lot of their breakthroughs happen by doing the homework, back testing. I can tell you right now that I've back tested 1,000 times more hours than I've live traded. Because, well, first of all, I don't like to be in trades very long, but but back testing is where I really had a lot of my breakthroughs. can you wait to position? Okay. Why do we wait until the top of the hour versus when we first see it? Paul, because well, I'll try to give you the simple answer. So the simple answer is because it then becomes duplicatable for everyone. So that's like the quick answer. The other thing is that most traders, especially in the Forex market, are waiting for a post, whether it's a 5-minute, 30-minute post, 1 hour, 240, 1 day post. And they're making a decision based on the post, right? There are ways to discretionarily trade after you get good at it without indicators. For example, if you're using price action, right? You can see on the bleeding edge within 15 minutes that it's not, if you have a lower high and a lower low, it's not likely that that candle is going to pull back up 15, 20 pips and make a higher high and a higher low. So you're pretty confident that the market's going to short, and then you can kind of position even before a post. But generally speaking, because you have so many traders worldwide, millions of them executing, a lot of times they're executing at the top, at the post, right? So if we're looking at a 60-minute pattern, we're looking at the correlation between major and minor on a 60-minute, and it would behoove us to not wait for the post, because the majors are going to react a lot of times contrary to what the minors are doing. You'll notice, especially with if we use the example of like a whiplash, right? By the time the whiplash happens, the intersection happens, the minors are kind of sideways, usually in a hiccup formation, and then the majors are still kind of extended up, and that's what causes for us to continue that direction. So there are a number of, or even hiccups and head fakes, right? Minors are more committed to the opposite direction, which allows for the majors to pull against them. Because it's a zero net market, that means that the majors can't just push the market up if there's not counterweight. There has to be losers in order for the majors to win. So they don't just get to decide where the market goes. They have to trick the minors essentially into shorting or going long so that they can go the opposite direction. That's how the market works. So if you had trillions and trillions of dollars and you wanted to make sure that it stayed that way, wouldn't it benefit you to disseminate false information into the market, into people that are wanting to learn how to get into the market and leverage themselves? Absolutely. Actually, for a while, I was convinced that oil companies lobbied against themselves so they could increase their prices. Think about that one for a while. Consider OPEC. You might not think I'm so crazy. And yes, Dan, all the back testing is done on the post. So when we back test them, we say, okay, did this pattern remain to the post? And generally, when we're back testing, we're not replaying. Well, sometimes we are, but we're not actually replaying the candle. We're looking at the previous posts and seeing what those patterns are, and then running the algorithm and seeing how they prove out. So Hydra is good, and it's almost a sure thing. And sometimes it's like you'll hit streaks with the Hydras where you're just like, man, I haven't missed the Hydra, And sometimes when I go and check how the alerts are doing, it's like, wow, I've gone, mind you, there it hadn't been very much, but I've gone like 2 months and I haven't missed a Hydra, So they're really reliable, but like anything else, they're in the market, they're always best served with other disciplines, and especially because using other disciplines can generally get you more pips out of the market. So let's look for another example here. So you can see they're pretty far spread out, right? So we might get alerts for them, but the alerts may not stick till the end of the hour. This would actually be considered 92%. That is, it's a doji, but it's red. And you can count it as 90 or 92% accurate. But we have our pattern, and the heads are up, right? So we've got our heads here, Hydra on the, or rather hiccup on the major, hiccup on the minor, gray down, black up, green down, red up. Necks are here. That means we're heads up. We're looking for a long trade. That's why it's our first parameter. We want to make sure that we have identified the pattern. Then we want to look for some other forms of validation. Within Mastermind, we want our patterns to have anywhere from 2 to 6 variables. That way it's not so complicated that you can't memorize them. And the variables have to be uniform across multiple currency pairs. So although I can get a Hydra to work on different currency pairs at 90+% accuracy, the variables would differ between Euro US and say, Aussie CAD, right? Perhaps we would need the pattern, pressure, and something else. Maybe not just contrary candle, maybe something happening on the TNTs, whatever it may be. But I would be hard pressed to take any of my patterns and not be able to get them to work on 90+% on any currency pair. However, the variables would not be uniform. So imagine if we had 5 different variables for 5 different currency pairs, that would be pretty useless, because that's a lot of information to remember on the fly. So it's better just to have something uniform and simple, so that regardless of what your level of expertise is, you could use these patterns. But here's the great news. You can take this pattern, back test it on your favorite currency pair, add your own variables, and replicate exactly what we've done. Only difference is you won't have an alert for it. That's okay, because now you've got something else in your repertoire that you can utilize to make profit in the market. So I don't have like a patent on this, right? You can do this stuff too. I've just done the legwork. All right, so we've got the pattern heads up, which means we're looking for a long trade. We have short-term bias in our favor. Again, we have green on top, and we're looking to buy, so we want green on top of red because that gives us our short-term bias. Long-term is the direction they're pointed. So if we're looking at the direction they're pointed sideways. So long-term is sideways. That's relative to 60-minute and how long they've been sideways, but we're not going to get into much of that tonight. But short-term, we have green on top, which gives us our bias. And you could say, yeah, we have our contrary candle, or we don't. Regardless, it's anywhere from 90 to 92% for a 5-pip buy without drawing down 25 pips. Right here, believe it or not, we got that trade. It went 7.4 pips. It did. I checked it as I was setting up today, and it drew down first, like 10 pips, and then it came back and took profit. So it moved up 7.4. And had we not gotten out there, it would have taken us for a ride and eventually stopped us out.
Is that only valid on the 60-minute?
That's a great question. Thank you for asking. Yes, it is only valid on the 60-minute. Well, how long have you been trading?
Short.
Yeah, I don't use a 15-minute.
Yeah, I've been just curious.
Yeah, I ditched the 15-minute. I know. So again, I need to be careful how I say this, but as coaches, we have processes that we've become really proficient at, and we've acclimated and adapted to certain things, like a 15-minute chart, or a 1-minute or 7-minute chart. I've heard some crazy stuff, but it's not necessarily duplicatable. It's not something you can write in a textbook and somebody get head knowledge and then all of a sudden be able to apply that head knowledge and create wisdom. It's you've got to experience it and learn it, and it may not be something that you can see for yourself. Maybe in the eyes of the beholder, the person, the coach, that individual sees something within the 15-minute that works well for them. I'm not saying the 15-minute doesn't work. I'm just saying, especially early on, you want to be grounded in what is common, and then branch out as you become more intelligible with trading. So the most commonly used charts in the Forex market are the 5, 30, 60, 240 in one day. I'm not saying you can't branch out, but I'm saying, especially early on, if you're adding a lot of extra stuff, you're pretty much watering down your learning process. You want to learn the foundations, the basics. Not trying to call you out, but I'm trying to help you. Good. And the more stuff you try to add to that process, just kind of waters down your educational experience. But feel free to backtest them. It's always be careful, because if you're not keeping record of what you're looking at, you kind of get short-sighted sometimes. Or if you've looked at a month and whatever you're looking at has worked out for that month, that could be exclusive to that month, right? That's why the Proving Ground we have 2015. There's a reason why we decided on 2015 is because just about every market condition that we've seen happened from 2015 to current. So consolidation, one direction, side, all kinds of crazy stuff. There was some geopolitical stuff going on. There was, tons of fundamentals within that time. So it's the proving ground, right? It's got to prove itself out through every market condition and come out vastly on top. All right, let's look for our next setup here. So you see how far apart they are. Within that time, we could very well have gotten, triggers for hydras, but they didn't hold out, right? They fell through before it held out for the post. Finally, here's a red one. So here it is upside down, right? Here's the eyeballs. So you've got, the reason why we call it hydras, because, well, we actually were throwing around some names early on with the group, and it was like Double Dragon. We trying to remember some of the other names, but the reason why we call it a hydra is because a hydra is like this two-headed serpent or dragon or whatever. So it has two heads. It's got the neck. It just helps us to visually identify it. But looking at it as a head helps us identify the neck and whether the head is right side up or upside down, which gives us direction, which leads us to ask the next question: are we short-term bias in our favor? So if we can identify that these are upside down, then we know the trade should be short, which means we want green on bottom of red and we want a green candle. If it's long, then we want green on top of red and a red candle. If we don't have the candle, we're still 90%. If we do have the candle, it just gives us an additional 2%. So here we would short. And again, it's regardless of where it happens. It doesn't matter if it happens in the channel, overbought, oversold. Regardless of where it happens, you're going to be able to get the desired result. Mind you, we test these even during announcement times. We don't discount announcements. So if a hydra happens during an announcement and it fails, it counts against us. Now, to have a 90 plus, that means that for every loser, I have to make that loser up with 10 winners. Otherwise, I don't prove out to be 90%. So when testing for yourselves, back testing and looking at theoreticals, whether it's pattern or otherwise, consider that. Is most of the time enough to be profitable? And most of the time is not enough. You have to have a high likelihood of success in order to be profitable, unless you have a really tight exit and it makes sense mathematically. So if you have a process and you say, man, most of the time it feels like I could win this trade. I see this a lot, and most of the time I feel like I could win it. That should prompt you to back test it and put it through the proving ground, right? Go back to January 2015 and test it forward every instance that you see that market, and then write down, compile whatever information, as much information as you can up front. Trust me, when we first started back testing, we would kind of nitpick as to what information we wanted to collect, and then realize, we didn't quite get there. Let's go back and collect this additional variable, when instead we could have just collected everything up front and then dissected it later. So it took quite a bit. Average of 70 hours after we mastered our process. Average of 70 hours per pattern, and 2 out of 3 would fail. And sometimes it was painstakingly 87, 88%. And we'd just be biding our time for that quarter to hit, right? So January, February, March, that's one quarter, April, May, June, so on and so forth. Once that quarter hit, all right, let's test that one again. Let's see if it proves out. And then, if it did, then we'd roll it out and then just keep an eye on it and make sure it continued to prove out. So here's an example of a sell. You got your pattern, short-term bias, green candle. So we'd short for 5 pips. That one went 12.8. There's that duckbill, right? Because that's generally what happens. On a 1 day, of course, that's a reversal. But on a 60-minute, a lot of times you'll see some follow-through, softening, small give back, and then continuation. Usually it's preceded by some type of consolidation. That usually is not the case. That actually moved back 9.3. Usually you'll see small give back, a little bit more continuation, small give back, and then consolidation. And then continuation, right? So you sell above the blue, buy below the red. Jonathan, no. When you get the hydra pattern, wherever you get it, whether it's overbought, oversold in the channel, you trade it. If it's heads up and it has the other parameters, the pressure in your favor, and then the option of the contrary candle, you trade buy for heads up, upside down heads, you trade sell or short. Sell above the blue, buy below the red. Yeah, so in some of those instances, that's the case, right? It almost seems counterintuitive because we're oversold. But again, we're not looking at whether we're overbought or oversold. We're looking at the correlation between major and minor. We're oversold, and the majors obviously want to do what? Sell. But they can't just decide they want to sell and sell. They have to, if we're oversold, there's nothing else to sell sometimes. So if they want to continue to sell, they got to get the miners to buy. And they do some pretty tricky stuff to get the miners to buy. First of all, allowing the miners to identify that they're oversold, because it's a pretty safe bet, right? We're already oversold. I've got, these different variables that tell me that I want to buy in this particular situation, whatever it may be, and then they buy in that situation. Again, a lot of those particulars are given to them by the majors, right? And do you guys know what market makers are? I was having this conversation the other day as well. What a market maker is. So there's a difference between ECN and market maker. ECN is electronic communication network. That's what we use through via MetaTrader 4, right? Capital City Markets is the broker, and they use an ECN. They're an ECN broker, electronic communication network. That means that they broker the exchange between us and the market, right? So we pay them a commission plus a spread to execute with their brokerage in the market, and then they get to set those parameters based on their liquidity partners. So a market maker will usually be like a prop firm. So a prop firm will give you money to trade on, but it's not like us where we're going to give you a percentage of the profit. They're going to give you a metrics usually based on the percentage you increase their account by. So if you increase their account by X amount, in whatever time it takes you, they'll give you this dollar amount. If you increase it by this other amount, they'll give you, and there's kind of a tiered structure generally. So you're not getting a percentage of what they make. You're just getting a dollar amount based on the percentage that you increase their account. You can also trade your own money after you've gone through their program, paid them the money like you do with us. And generally it's pretty stringent, right? You gotta hit all the metrics and follow all the rules, and then be, ultra proficient, even at their 50-60% win rates, in order to qualify to become, manage their accounts. So it's vastly different. But here's the kicker. Prop desks and market makers, you trade with their platform. You may not even trade with MetaTrader 4. You trade with whatever their platform is. And they're the broker, and they've trained you. So let's say they've got, 100,000 members, right? And some of these prop desks and market makers have 10 times that amount. 100,000 subscribers, and they're getting their education. They're learning how to enter and where to enter based on the information you've given them. Well, those prop desks, those market makers can see your entries and know when you're going to enter because they told you when to enter. And if enough of their members enter where they told them to, abided by the rules, these prop desks, these market makers will trade against their own members. It's not illegal. There's reasons why Dodd-Frank was created, so that they could continue this shakedown. Banks are too big to fail, but they can't play against each other. It's a losing game, right? So they use the ants, right? They're the grasshoppers. There's many more ants than there are grasshoppers. And they use the ants to do something contrary when it suits them, and then they'll do the opposite. Great examples, and I've used this as an example before. And the only reason it sounds, for some of you guys that have been with me for a while, I'm sure you guys feel like I repeat myself quite often. That's because we get new people in, and I'm sometimes just reflecting on conversations that I've had before, and I want to make sure that things are clear. So a good example of the majors manipulating the miners is with announcements, which is why we don't trade announcements. It doesn't matter what an announcement says they're supposed to do. It doesn't mean that the majors are going to do that. By definition, does anybody know what a rate increase is when the FOMC increases the rate, the interest rate? So for those of you guys that don't know, the FOMC increases interest rates on what banks make for sitting on money, basically, in overnight exchanges and things like that, right? The reason why we associate it with higher interest rates for lending is because that's generally what the banks do when they're making more money by just sitting on it. There's no risk in it for them, right? So then if they're going to lend it out, they're going to make sure that you have a better credit score and you have collateral or whatever it may be, which discourages, and they charge a higher interest rate to you to borrow that money, which discourages individuals from borrowing to buy a car, buy a house, start a business, whatever it may be, right? When the FOMC has low interest rates, it affects the dollar, in our case, negatively, right? Because the value of the dollar decreases, but it helps our economy because now banks are incentivized to lend out money because they're not making so much by sitting on it, especially with negative or zero interest rates, right? It's like a fire sale. It's like just lend it out. That's how you end up with subprime lending and things like that, because FOMC will go to banks and say, hey, we'll incentivize you to lend out more money. So banks are like, all right, all bets are off. I don't even need to validate if you have a job or not. You know, I just saw you holding out a will work for food sign, but I'm going to give you, $500,000 line of credit to go buy a house, right? So they get incentivized to do that. Well, by definition, a rate increase increases the value of your currency, whether it doesn't matter what currency it is, right? The Bank of England does it. They have interest rate increases. FOMC does it. They all do it. All centralized banks, right? They have rate increases and decreases. So by definition, that increases the value of your currency. So if you're trading euro versus US dollar and your FOMC comes out and says that they're going to increase interest rates, what does that do to the US dollar? It's supposed to create strength, right? So on the euro US, where does the euro US go if the US is strong? Shorts, right? It shorts. So if bets in Vegas, which they take bets on this stuff, by the way, if odds are in favor of the FOMC increasing interest rates when the quarter's up, and traders are aware of this, banks will do what's called sell the rumor. It even has a name. This is not conspiracy. This is fact. This is how the game is played. The problem is not enough people know about it. And that's by design, right? Who's disseminating the information? The bad guys. They're the bad guys. You're playing against them. Don't get it twisted. They're the bad guys when you're in the market. They're the good guys when you want the home loan. But they're the bad guys when you're in the market. They are the enemy, right? So are other traders, by the way. So you're all enemies of each other. No, I'm just kidding. No, but so they'll sell the rumor. So traders will then go long on the dollar because FOMC is increasing interest rates, right? Buy the dollar and short gold, sell gold, because gold works contrary to dollar, even though, the fiat. So we're not basing our dollar on gold anymore, but that's still the way it works. So the banks, if they see that that's the perception, that's the speculation, right? The media outlets are reporting this. If you go to Forex Factory, the forecast is that they're going to increase interest rates. All the major headlines are talking about rate increases coming, right? MBS is going crazy. Mortgage-backed securities is going crazy. And the announcement comes out, and sure enough, we got a rate increase. And traders everywhere say, well, this is sure thing. Let's bet the farm, go long in the US dollar, short gold. Well, the banks know exactly what you're going to do now, and a whole pile of you just did it. So what are they going to do? The opposite. They're going to short the dollar and go long on gold. They just ate your lunch. Because it doesn't matter what the announcement is. They're hiding their big moves behind announcements. They don't care. They don't have to follow that rule. They don't have to increase the value of the dollar, especially not initially, right away, just because a rate increase happened. What they can do is take it from you when you think you've got a sure thing. Moral of the story, there is no sure thing. The information that's disseminated is intentionally designed to deceive you, because it's a zero net market. That's the way the game is played. Now, that shouldn't concern you. You know, honestly, it shouldn't be that big of a concern to you because we can see what's happening with our indicators. That's why you have major and minor. So a lot of times people say, well, follow the majors, whatever the majors are doing. Well, that's not necessarily the case. It's what are the majors doing as it compares to the minors. That's why we have the minor lines there, right? And what's the pressure in that direction? Is it even worth taking in that direction? There's a lot of things that you consider, but when you do that and you become more acclimated with the indicators, and of course, my hope is that I provide these patterns for you so you have some insight into how they work, then you become more proficient. You can trade at a higher level and become callous to the losers that happen few and far between. It was not a Hydra and why it did not work out. Yes, Thomas, let's look at that. I think that's the second time I've had that question. Let's see. One, two, three, four, five. One, two, three, four, five. Okay. So let's go back to, so this right here, actually this is, I think you might be talking about a different time, and I'll check that one too, Thomas. But this one is a Hydra at 1800. Oh, that would be 12 Utah time. Okay. So 1800 Hydra, that would be a short, right? Because you got green up, red down, gray up, black down, and the heads are upside down. So that would be a short-term bias to the short side and a contrary candle. So right here, we would short this for 5 pips. Now, the question is why it didn't work out. Well, because they don't always work out. But is it over? Let's find out. It's getting there. Oh, might be there now. Nope, 16, 14, 16. There we go. 24.3. That's in my opinion, absolutely, it's a loser. That lost 2 hours in. But you know, were all the parameters there? Yes. Based on the pattern, would there be any reason to not take that Hydra? No. You would have taken it, and it would not have worked out. It's true. They don't all work out. And it's okay. It's totally fine. And until you get okay with that fact, you're not going to be successful at this because you're going to be too emotional about the losers too often.
Cost of doing business.
That's it. Cost of doing business. Thank you. Couldn't have put it better myself. I'm going to use that from now on. So if you hear me say it numerous times and take credit for it, just think in your head, you were actually the one that gave it to me. Because I probably won't give you credit for it. I was just kidding. I think that was the one you were talking about, Thomas, and I think somebody else had the same question. But you know, if we were looking at it from a technical standpoint, from where we started here, we're in an uptrend, obviously. We had slight movement down, caught the Hydra, didn't get enough to the short. What did we get to the short side? 3.2. Okay, let's do this. Since we were talking about positioning, right, and other disciplines within the market. So let's go to this chart. Let's pull up a 5-minute. If we were going to try to take a short, which direction would we want to position the 5-minute? Would we want it to be overbought or oversold if we're looking to sell? Overbought, the opposite, right? Okay. So let's look to see if that would have helped us out at all. So there's our Hydra. And all the parameters are there. It's looking good, 92% accuracy. And this is one of the 8%ers, right? And we're overbought on the 5-minute. That settles it. It just wouldn't have happened. Everything is there, even if you try to position, right? It just wouldn't have happened. And sometimes that's just how the cookie crumbles. I mean, we weren't even on, like, let's see, were we on any kind of identifiable? Yeah, I guess. We were on a support level. I mean, I guess we could, you know, raise an argument for that. But there was enough there to justify taking that trade and losing on it, period. If you hedge or are planning on hedging, cool, you can still recover it. Otherwise, it's a loser. That's it. So I think the reason why a lot of folks are having such an issue with this is because, especially the Hydra, when you take it, it just works. You know, and when you take an alert from the TPG, they work, right? They work really well, and you hit them so often that when a loser happens, you're kind of like taken aback, like, well, that doesn't usually happen. Why? I must have done something wrong, right? No, it's just 8% of the time or less. You know, you're gonna miss it. And it's okay. Right? Move on. There wasn't much there that, based on the pattern, that would justify not taking it. All right, so let's go back. Nice. So Thomas says it was a good thing. For some reason, I did not take it. Good call, Thomas. You might have been the only one. Wrong. What happened? Oh, that's why. Okay. There we go. Okay. Does anybody have any questions about the Hydra? I got about 5 minutes, guys. All right. Let's get to our other examples here. Yeah, Brad, absolutely. So Brad was just commenting, sometimes just knowing your analysis was correct is the important thing. Most definitely. Okay. So I've got my main Ninja on like, I don't know, he's been out for weeks now. Kind of one of those, I'm going to pull one next week. I'm leaving tomorrow, and it's one of those, I don't know when I'm going to come back type situations. So I think he's kind of on one of those right now. And so I've got Stormy D, for those of you guys that are Mastermind members, I got a Stormy D and Perfect Storm. I sent him an email like, hey, man, I know you're still gone, probably having a good time, but what do you think about hooking me up and, you know, setting this up on the alert? So we might have Stormy D set up on the alert for us. Why is this not this week?
So you've already completed on the back testing on it?
That's part of it. But the back testing, the way he does it is a push of a button and it's done. Like, click, all right, it's done. Here's your output. So it's, yeah, I'm sure it will. There's a threshold. And so when we're kind of vetting to see if, I've got these guys working on a whole lot of things, and I felt like something was taken away from me when they started pressing a button and the back testing was done. It almost cheapened all the hard work that I've done over the years, you know. But smarter, not harder, definitely. So I'm not going to fault them for that. But every once in a while, I'm like, well, I want to see if I can prove this out. So I figured out that there's this threshold, and you can randomize and look at certain areas and take 40 of these patterns randomized across the proving ground, and 40 is that threshold. Once you cross that threshold, you have a high likelihood that that's going to prove out, that it's going to prove out successful when all the back testing is done. And the Perfect Storm and Stormy D came in at like 96% accurate after that threshold was crossed with 52 trades. So we even went beyond the 40 trade, or the 40 examples, went to 52, and it came in at 96. So that gives us 6% of breathing room, which, you know, I mean, by the way, 1 or 2 losers could undo, just that simple. But it's very, very promising. Let's see. Okay. So I'm not going to be able to get to the next example and continue. We're going to break from we're going to take a break. For those of you guys that are going to stay for the 7 o'clock, I'm not sure who's doing it tonight, Matt Parkin, but since I'm assuming it's Matt Parkin. Since I don't see him here yet, they might not have anyone. If they don't, you're stuck with me for another hour. I'll find out here in just a second. Otherwise, let's go ahead and take a break and reconvene at 7 o'clock. Thanks for joining us, guys. For those of you guys that are online, feel free to hang out until I figure out if I'm going forward for the next hour. If I am, I'll continue to broadcast.
How do you get the advanced channel? I've heard you talk about it a lot, but I don't have it on my phone.
Oh, do you have the TPG channel though, right?
Yeah.
Okay. Usually it's by request, just because we don't want to just plug people in there and they start getting alerts and thinking they work the same. But let me plug you in here. How are you registered in Slack?
Let's see, like my username.
Yeah.
Well,
Thanks,
it
John.
just has my first name, just Jeff.
Okay. There may be multiple Jeffs. Let me see your logo. Okay. I got it right here. There are multiple Jeffs. Okay. And you're on TPG already, correct?
Yeah.
Now you're on advanced, sir.
Awesome. Thank you.
My
There it
pleasure.
is. All right. More alerts coming.
I got hung up in traffic, so I was late coming in.
Yeah.
You know, when you were talking about the Hydra, I got confused because it seemed like you did opposite of what I thought you should have been doing.
Right.
What is that? Could you just give me a brief?
Yeah. So
I'm
a
sorry.
lot of these patterns, and that's the reason why we've developed these patterns, is because the indicators are very nuanced. So there's a way to look at them that's reactive, meaning if they're pointed down, you trade down.
Mhm.
Pointed up, you trade up. And there's another way of looking at them that's very much more predictive. And when you look at them in that respect, then you start really paying attention to how the majors interact with the minors, and having certain scenarios why the majors do something that almost seems counterintuitive. I don't know how familiar you are with our patterns, but a really good example of that is a head fake, where you actually have major and minor crossed in the same direction, and you would actually trade it the opposite direction because of some of the other parameters. So it's not a flaw in the indicators. It's actually telling you that very thing. You just have to be proficient enough with them to be able to read those nuances.
Okay.
Otherwise, you're stuck with using them reactively. You know, overbought, cross down, short, oversold, crossed up, buy. You know, or something in between, or waiting for pressure to look correct, and so on and so forth. And sometimes in doing that, you kind of miss a lot of the move, right?
Mhm.
You're waiting for everything to kind of line up and look okay and look good, and then you take the trade. Where 3 candles ago, we've already been in it and took multiple trades, you know? So it all comes with experience. And so our hope, again, is just to try to give you guys some of this insight so that it shortens the learning curve. You don't have to stare at these charts as long as I have to understand some of these things. Ultimately, you're still going to have to do the legwork, back test, you know, put some time behind you before you get, you know, proficient. But I see Matt parking, guys. I'm going to sign off to the Proving Ground so he can get set up. Thanks for joining us. If you guys have questions, feel free to email in, and we'll talk to you guys next time. Thanks.
So I